There is an extreme contrast in the U.S. housing market. It's actually kind of ridiculous. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Lots going on. My name is Randy Patrick. I'm your host, putting the realism back in real estate. Lots going on today. Today is the last Tuesday of the month. And typically what that means is, guess what? Case-Shiller information comes out. So we'll talk about that. And we'll talk about some of the, I said, extreme differences, contrast, dichotomy, whatever you want to call it, in the U.S. housing market. We're entering into kind of a really weird sort of time right now, weird situation. And, you know, it's just, there's lots going on. I'm sure you've seen it in other videos. You've read it in the news. As I said, I'm kind of over all this information. I feel strongly about where the market's going, and I know what I'm going to be doing the next little while to participate in the housing market and do what I need to do for business and personal, wealth growth and the whole bit. But the point is, there's just, if you're looking from the outside looking in, there's such a difference, and it's like, who do you believe? We don't know. So anyway, if you're not already a subscriber, if you could please help my channel grow and subscribe, I'd really appreciate that. Why? Because I mentioned I'm putting the realism back in real estate, giving you data that you need to know to make educated decisions. All right, thank you. Here we go. So again, the big news today is Case-Shiller information came out. But first of all, dichotomy, that's what we got going on here. That's the Cambridge Dictionary's, I guess you could say, definition. Basically a difference between two completely opposite idea or things. Yes, the housing market is in a dichotomy. Why? Because we still have price growth across the board and in many markets. Yet we are seeing a potential of millions of people facing eviction from their places of residence right now. So it seems there's this huge contrast going on. It is what it is. We'll see if we can get through it. So anyway, as we move on, so Case-Shiller today, that's what came out. So basically, you're going to see all the headlines. U.S. home price growth decelerated in May, so that's interesting. So we see a little bit of deceleration going on. What else do we got going on here? Okay, this is the next. Okay, home price rose at a slower rate in May, according to the Case-Shiller index. As well, home prices kept on rising in May, but at a slower rate. So the consensus among the major news reporting, articles, generators, whatever, newspapers, etc., things that I look at, Wall Street Journal, Bloomberg, Market Watch, etc., is saying that, yes, Case-Shiller, we're still seeing values rise, but we're starting to see the slowdown in the values rising, which would seem to make sense. So, of course, this is the formal release from Case-Shiller. So it's known as the S&P, so Standard & Poor, CoreLogic, Case-Shiller U.S. Home Price Index. There you go. It released its data for May. So yes, we were at the end of July, but realize that typically what Case-Shiller does, it summarizes the past 3 months of March, April, and May data. And what it does is it makes some, it tells us what they believe property values are doing. So we had an annual 4.5% home gain in May, which is down slightly from the previous month. And just a note here, they typically poll major metros across the country. They have a national housing index, which is what we talk about. They have a 20 metro housing index and a 10 metro housing index. And at this point in time, I believe Wayne County, Michigan, that's the Detroit area, as having delays, so they're not reporting on Detroit. This is, I think, the third month in a row now that they're not reporting on Detroit, so I don't know whether there just is a significant situation going on at the county offices on recording the data, or whether something else is going on that they don't want to report. I don't know. I've heard rumors that's what people are seeing, just because other counties and other clerks and recording offices are still doing their job. What's so different about Detroit these days? I don't know. But again, just food for thought, everybody. All right. So year over year, we got basically a 4.5 annual gain in May, down a very small, like a percent of a point from a 4.6% gain in April. So the 10-city composite came in at 3.1%, down from 3.3% in April. And the 20-city came in at 3.7% year-over-year gain, down from 3.9% the previous month. So we are seeing, again, a little bit of slowdown in the annual year-over-year gains on home price appreciation. Phoenix, Seattle, and Tampa recorded the highest year-over-year gains among the 19 cities, again, excluding Detroit, in May. Phoenix led the way with a whopping 9% year-over-year price increase, followed by Seattle with increases in the year and 6.8%, and Tampa with a 6% increase. So the 3 of the 19 cities reported higher price increases in the year ending May 2020 versus the year ending April 2020. So there you go. We'll go to the charts now. But first of all, before we hit the charts, May's housing price data was stable, according to the producers here of S&P Dow Jones Index. The National Composite Index rose by 4.5% in May, compared with a growth in the 10 and 20% being a little bit down too. In contrast with the past 8 months, May's gains were less than April's, although prices increased in May. In other words, they did so at a decelerating rate. We observed in August development in the city level, prices increased in all 19 cities for which we have data, but accelerated in only 3 of them, in contrast with 12 cities and last month and the 18th the month before that. So we're starting to see a little slowdown the price point. More data will obviously be required in order to know whether May's report represents a reversal of the previous path of accelerating prices or merely a slight deviation from an otherwise intact trend. So that's the whole thing, is that we are looking to see what's going to happen with prices. We're pretty much peaking. We've been peaking for the past how many months now? We're just getting a little bit more each time, farther and farther away from the 2006 peak, a little bit more every month. We know that the past few months of sales, we've had lower sales volume count. We know that we've had lack of inventory in the marketplace, the retail marketplace, so therefore a little more competition, or home values are going up because of the lack of inventory. So for me, it's kind of like that does there's less homes being sold. Those homes that are being sold are commanding much more money, and that's why we're seeing some of these increases. So I look at it going, again, we just see the final result. We don't really see whether what about this time last year? Was there double the home sales going on? You see, so maybe the sample size is smaller. Clearly, is that skewing the numbers? Don't know, because we don't see the information. But again, looking at Phoenix, Seattle, and Tampa being we'll call it the big winners over through the May data. All right, this is the graph, so you can see that we have the 10 city composite, which is the thin line. The thick line is the national, and then we have the 10 city and the 20 city composite indices. All right, if we go, you can see how the trend now, of course, right in the middle, the big bump in the middle, that was our peak, which was July 2006. So we're trending higher than that peak where we are today. So that's the scoop on that. Just to show you, that is the number. So the national index is 18.6% above the previous peak in the last that was there from the last housing, we'll call it bubble boom crash crisis. You can see, it's 18.6% above July 2006 on a national level, and obviously, the 10 and the 20 cities are 8 and change, almost 10 and almost 5% above the peak there. But you can take a look at the difference. I mean, to me, I always look at the trough, which was 2012, the low point. You had a 2006 peak, 2012 trough, so roughly 5.5 to 6 years going on there. Nationally, it was almost 30%, was 27. Metro-wise, the big metros were over 35%. And now we take a look at, from the trough to where we are today, we're in the 60%, delta there. So that's pretty big. Again, 18.6% from the last peak nationally across the board. All right, here we go. If you want to take a look at the list here, and we'll go over some of these. This is the year-over-year change. So they put out the year-over-year change, which people want to look at for the top 20. Atlanta, 4.2% change. Boston, 4.3% change. Charlotte, 5.4%. Chicago, only in at 1.3%. Cleveland, 5.7%. Dallas 2.8, Denver 3.9, Detroit, as we mentioned early on, Detroit is not reporting, or Wayne County, Michigan is not reporting information for whatever reason. So there's nothing in Detroit. Case-Shiller basically says once they get information, they will repopulate and adjust and let us know what the scoop is. Las Vegas 4.2%, Los Angeles 3.7%, Miami 4.0%, Minneapolis 5.5%. New York only 2.1%. Again, Phoenix at 9%. Portland 4.2%. San Diego 5.2%. San Francisco 2.2%. Seattle 6.8%. And Tampa 6%. Washington 3.5%. That is your year-over-year price gains or value gains on the top 20 metros. We take a look at this. Again, U.S. home price acceleration ends in May as urban exodus strikes. So, we're still, we're seeing a small decrease in the overall value in Case-Shiller. But, we're still too early on to see whether any of the, we'll call it social unrest or political issues that are happening across the country in specific cities have yet to affect. I mean, we know there's a lot of things going on. You've got COVID-19 and denser, and you have very high expensive locations like New York and San Francisco. You have other cities that are on this top 20 metro that have had other problems. So, there's a number of reasons why people may want to move out from those cities, and whether that's going to affect price points as far as, again, not a lot of this is happening now or like kind of like, May, June, July, like, what I mean? A lot of what we see going on is happening now, and we may not see the effect. I mean, well, at least Case-Shiller is not going to pull the effect of what's happening in real time for 2.5, 3 months. But again, it's a perspective here, right? U.S. home prices had appreciated for 9 straight months ahead of today's Case-Shiller data, which was expected to accelerate further in May. However, a notable downside surprise for the slow-moving index, home price growth slowed from a revised lower, 3.9 to 3.6% year-over-year in May, below the 4% that was expected. This, I think, is they're talking about the 20. They're talking about the 20 index here. So basically, this was the biggest growth disappointment in years. And again, when we look at things, it's only a few. It's only not even a percent. It's tenths of a percent, but we're looking for trends here. Is this enough to start to indicate that we're going to have some depreciation or decelerating appreciating going on? Tough to say. We'll see what happens. All right. When we go deeper into this, another comment on that article was New York and San Francisco saw month-over-month declines in home prices. Is the urban exodus accelerating? So we'll have to see how that's going to play out for the next little while. And again, Case-Shiller also produces the month-over-month change. So if we take a look at that, and I've got that one over here as well too. So the month-over-month change is fairly straightforward here. They've got a non-seasonally adjusted and a seasonally adjusted. So in the non-seasonally adjusted column, which is the first column, basically New York really had 0% change, and San Francisco actually had a negative 0.2% change. So that's the reference there. So on this 20 city index, on the non-seasonally adjusted, we're actually seeing a little bit of price decline going on. Seasonally adjusted, you're adding Las Vegas, Minneapolis, New York, San Francisco, Seattle to the mix. So that's adding, there's a bit more decrease going on there if we do seasonally adjusted, however they calculate that. But the point is, will we start to see deeper trends in price declines as time goes forward? A lot of stuff happening right now. That's why, I think we'll start to see that as time goes on. Listen, right now we're in the peak selling season, if you can even call it that, with respect to what's going on in the marketplace. We still are going to feel the pinch and a short-term bounce with respect to, competition for homes, less inventory in the marketplace, people that have to move. Maybe if there's a choice, you don't move or you wait to see things out. If you have to move, you got to bite the bullet and grab it. Clearly, we've got another round of quantitative easing going on. Interest rates are at lows again. So we're going to see much more, your what they call your buying power is increased with lower rates. The properties themselves are not less expensive. It's your buying power. based on interest rate, being lowers or declines in the interest rate on a going forward basis here. All right. Here's when I talk about the dichotomy or the extreme contrast in the housing market. We just came off saying, hey, we're still growing. Look at Phoenix, 9% year over year. I mean, that's a pretty good number. If you've got a house in Phoenix and you're looking to sell, it seems to, when's it going to stop? But so that's on the one aspect. We've got all this growth still going on, albeit most locations see the trend slowing. There's still growth. It's not negative yet. Now, on the other side of, I guess you could say, of the extreme, ends of the housing market, well, we had an eviction moratorium. So there's an eviction moratorium that really expired the end of last week. So really, this is, sort of, we'll call it the federal eviction moratorium that was going on. And this basically is, for renters that are living in, we'll say, homes or complexes that have federally backed mortgages. So there's an eviction moratorium going on for their residences. We all know that the eviction moratorium essentially expired a couple days ago, so the end of last week. And so when you start taking a look at the numbers, they're talking 12, 13 million people right now are exposed to losing their place of residence through the eviction process. This is kind of on the federal level. All the states across the country can have their own eviction moratorium guidelines and timelines based on what's going on in their individual state. So some states, the eviction moratorium locally has been lifted, which would not apply to these federally backed, mortgages here. Others, I know, for example, I'm in Florida. Ours expires on August the 1st. So who knows what's going to happen, though there is some indications. We've already heard, if you look at the news, that the expectation is there's going to be another round of stimulus checks coming, and they will be addressing, very shortly the eviction moratorium. So right now, like I guess you could say, if you're a landlord, you could file an eviction right now. So you can file it. How far that's going to get in the court systems, who knows, and whether it's going to be derailed or not. Clearly, we're at this turning point in the housing market with all, again, it's who's paying for what, right? If you're a landlord, say a mom and pop landlord, and you have a single family home or a duplex or up to a quad, so it's still under the single family designation, either you're taking it on the chin with respect to not having rent coming in, and possibly you've got a mortgage on the property. Chances are you probably don't have forbearance on that. You may not have qualified for forbearance on a rental piece of property. The interesting thing about the whole eviction moratorium, as a renter doesn't necessarily have to prove, at least initially on, that they're suffering due to COVID. So that's kind of the issue. So people can choose not to pay and see what happens. So not necessarily fair for landlords. If you're in a multifamily complex where it's it's commercial, designated commercial, 100 people units, whatever, there's still costs. Someone's got to pay the bills. Someone has to pay the financing on that, the operations, the whole bit. So, this is a trickle-down effect that's going to hurt people. And it's too early yet to see the hurt or to see how that hurt manifests, but it's coming. Trust me, it is coming. All right. When we take a look at, it's the CARES Act, and that's what covers all this here. And basically, how many rental units are covered by the CARES Act? Well, let's just take a look at single family. So we got about, overall, they think almost 44,000 rental units across the country. It's a good estimate. Out of that 44,000, you got about 22,000 single-family properties, which if you take a look, you can break them down into basically a single-family home, two units, duplex, or 3 or 4 more units, triplex, quad. And then when you take a look at, what percentage of that is actually taken care of by the CARES Act, there's your numbers there. So, and then take a look at multifamily properties as well too. So that's why the total exposure of at least renters from the CARES Act is about 12 million right now. That doesn't really, and that's just, again, the CARES Act. That doesn't include the other parts of the single family, multifamily that's not covered by the CARES Act, that maybe are in individual states that have their own eviction and foreclosure moratoriums going on. So, this is where when you take a, when we take a look at numbers, it's like, that's a lot of people. So, could all those people be evicted at once? Chances are no, just because if you think about it, the court systems, can't handle suddenly this onslaught of evictions being filed. I mean, I can tell you that there's evictions that are already filed and maybe waiting to continue once the moratorium's lifted. So that's going to go right away. Then landlords are going to send notices and start to file, etc. So, there's a lot of stuff happening here. So will this all happen overnight, and will suddenly 12 million people be homeless? Not going to happen. Number one, just physically, logically, you just can't crank through that many under the current court systems administration. So that's so there's still time there, and I do believe that that we've been hearing this, that something will be decided in the next couple of days with respect to what's happening here, extensions, more moratoriums, whatever. But all this is just going to put more pressure on other people. So if you're a single family landlord, have a single family rental property, and now you can't evict, well, guess what? You're still bearing the cost. You're still paying insurance on the property. You're still paying taxes on the property, right? Are you still paying a mortgage if you have one? I don't know. Have you stopped paying your mortgage, or are you continuing to pay the mortgage? Or are you dipping into your savings? Is now your rental property non-performing? Okay. Have you had enough of it? Do you want to get rid of it now? Do you want a quick sale and just get rid of it to somebody else and relieve yourself of the problem? This is going to have far-reaching implications that's really not discussed about in the media. We just again, when you take a look at the perspective, is we've got renters and homeowners and issues, but no one's really focusing on how that's going to trickle down through the marketplace and how that's going to disrupt the market as time goes on. But again, just to quantify, that's kind of my point, though. When we see a large contrast in, hey, on one hand, wow, we've got still appreciation and things are great if you're a homeowner, you want to sell. On this other hand, we've got 13 million people who could in theory facing eviction if things don't change. So that's a really big difference in contrast of what's going on in the housing market. All right, again, basically just some of that summation. We estimate that nearly 2.8 of the 22.3 million single family units are financed with federally backed loans through Fannie, Freddie, or FHA. You know what I mean? So when you start taking a look at that, so first of all, I guess that answers your question. These are that group there. So 2.8 million of 22 million single family rentals, 2.8 million have mortgages that are backed. So those people have protection. I don't know whether those people who fall, like the landlord owners that fall in that category, get protection from Fannie and Freddie on their mortgages. See, that's the kind of thing I don't understand, because it's not really clearly stated. Like, in other words, you can't evict me, but does the for example, first of all, it's costing them money. They're losing. What I meant to say was, do these landlord owners of 2.8 million of these single family residences that have eviction moratoriums, do they qualify for forbearance? I guess that's the real question. So in other words, can they seek at least a temporary relief from to work both ends? So if the renters don't have to pay and they can't get evicted, can the landlords get forbearance, and how will that work out in the end? If you're not paying, you can't be evicted. Until you are, you still owe the money. It's just a negative loss. It's a net loss for the landlord. So it just goes to show you. So that's, for me, 2.8 million people that are carrying mortgages on potentially properties that could, that renters could or could not be paying the mortgage. We don't know, so to speak, right? Sort of paying the rent. So again, just when you start looking at the numbers here, so I'm trying to figure out what's the exposure? So, let's just say half of that. Let's just say, a million. Just say a million of these landlords, are going to say, I don't know, think about it. What's, if you think about it, you got 4.5, anywhere between 4 to 4.5 to 4.75 people in forbearance now. The numbers fluctuate here and there. I'm just putting some thoughts to it. I'm not making sense here clearly, but when you start thinking about it, going, well, out of those 2.8 million, how many of those people can get forbearance, and in the end, will they be able to recover from the forbearance over a period of time, or are they going to get stuck? Are they going to fall into the foreclosure process? That's kind of my real point here, is that we don't know whether the availability of forbearance for these people, of the landlords, is there, and could they recover, and how that's all going to work out. So again, big question mark. Who knows? Major issue going forward. All right. Facing eviction. This is kind of a nice little chart. It just kind of show each state and the renter population. So clearly you've got Texas, and Florida, big renter populations. The dark blue, you got Louisiana, Mississippi, and Tennessee, big renter populations. West Virginia, 59% renter population there. You know what I mean? Obviously New York, New Jersey, in the mid 40s. Whereas California, only 37% in California, Arkansas up there, Alaska up there as well too. So, certain states are going to get hurt more with, as a percentage of who's renting and who's not. I know from we'll call it a pure volume perspective, you've got New York, you've got California, you've got Florida, you've got Texas. That's the true, even though California percent may be reasonable, just the sheer volume. The percent, lower percent of a larger state still going to be sheer volume. So that's kind of the situation we're dealing with right now. So definitely, going to hurt the market. Landlords are going to have to figure what they can do, and we're going to see some carnage here, and that's going to start part of the housing, the distressed housing market sliding for sure. All right. This I found interesting as well too. That's why I find this, again, back to the whole extreme contrast in the housing market, the dichotomy. This came out today. Homeownership rate in the U.S. soars to the highest level since 2008. So basically 2008 was, I guess you could say, kind of just before everything was kind of breaking apart, the last housing crisis. All right. So we technically had high homeownership rate just there. Then it slid down to, from in the high 60s to 62 or 63%. And that was the housing, that slid to the housing crisis, in the trough in 2012, basically. Well, we're back to a new high now, which I really find kind of interesting, and I'm not too sure whether I really believe this or not. Take a look at the graph on this, guys. So when we take a look at the U.S. Homeownership rate jumps to the highest level since 2008. Well, basically, it's saying to us that the rate was 67.9% in the second quarter, according to a Census Bureau report on Tuesday. It was the fourth straight increase, climbing from 65.3% in the previous 3 months. So really, we're seeing a 2.7% increase quarter to quarter. So first quarter to second quarter of homeownership rate. And why I'm actually questioning that is because what did we see during, we'll call it April, May, and June in the real estate market? Like, what did we see? Well, if you take a look at it, if you remember what went on, we saw sales volumes decreasing. So we saw April sales down on existing home sales. We saw May sales down. Okay, we saw a little bit of an uptick, I think, in June, but it was still year over year, and the uptick was, we're talking month to month. Okay, we saw big decrease in April, big decrease in May, a record increase from May to June on the month to month side. All right, but still year over year it was less in April, less in May, less in June. So if we saw less homes being sold from the previous year, how did we see this spike in homeownership? To me, that's the question. Like, in other words, we didn't, why isn't the first quarter spiking like that? But we see the second quarter. So I don't understand. So again, that's just, to me, this information doesn't make sense. I would see it just because, again, if we're seeing less homes, well, sure, every year there's an increase, you can see that. But I guess when you start taking, just look at the chart. I mean, going from 65 and change to 67, what I mean? Like, that's in a quarter or even 6 months. It just seems to me like a really big jump in a time where we know that the actual number of homes sold was lower amounts than the previous year. So yeah, I mean, you can net and go, okay, well, still people bought, and maybe it pushes the overall homeownership rate upward. I do that's, I guess, math consumption. If there's 100 houses out there available and to live in, and this month we sucked up more of that available housing. I mean, obviously our homeownership rate's up as a net number, but I just find that spike to be somewhat unusual. I don't know if people think that's unusual or not. I don't know. I just think something doesn't make sense to me personally when you think about the fact that we had less volume of sales, and the seasonally adjusted sales were earlier in the year was 5 million in existing homes, and it was coming in at 3.9, 4.2, whatever. You know what I mean? So I just don't think it's maybe we're going to see more or revised information when again, usually kind of like the new home sales. We always see major fluctuations after it's first reported, either for better or for worse. So maybe this could be the same thing. Just something to keep in mind. I just found that to be very unusual given the extreme jump there. Again, my perspective on things. All right, guys. So having said that, that's why, again, the market's whacked. All right. It really is. High appreciation. We're hitting record appreciation via Case-Shiller from 2006. We're looking at record number of potential evictions across the board, big time issues going on, and we're now seeing a remarkable spike in homeownership rate over the past quarter. So I don't know. Go show you that the market is interesting and it's difficult to understand, tough to plan for the future. I feel good about where it's headed and what's going to happen. So if you want to know more information about that, certainly reach out to me, everybody. There's my email. Send me an email. Happy to talk. Send me your telephone number, your cell phone number, so I can text you and we can set up a time to talk. Again, if you're looking for investment opportunities, we got them going on here. Looking for multifamily, mobile home, whatever, reach out to me, please. Looking for help purchasing a property, again, reach out for me down here. And if you'd like more information on what will probably be a significant amount of distressed properties coming to the market fairly soon and over the next 1 or 2 years, you need to reach out to me and find out what the deal is on that, how I can help you, how you can be trained, and how you can participate in either finding your primary home, your dream home at a better price, and investment opportunities as well too. So having said that, thank you very much, guys, for the views, likes, comments. We'll be looking forward to talking to you guys later on this week. Thank you.